We all see Nvidia dominating the headlines and hitting a $3 trillion valuation. But the harder question is where that capital flows downstream. Which secondary companies successfully turn Nvidia's demand into revenue? That search leads directly to the AI networking silicon sector. This basket of companies provides the specific infrastructure that allows those massive GPU clusters to actually talk to each other. Sitting right in the middle of that basket is Marvell Technology. It's the mid-cap leader in custom chips and optical data routing, and the market has aggressively bid it up, driving the stock 36% higher in just the last 20 days. But if you look under the hood, the math tells a conflicting story. Wall Street analysts are publicly telling retail investors to buy, yet the underlying numbers suggest the stock has completely outrun its actual value. Marvell reports earnings tonight, and because of that aggressive run-up, this print serves as a direct test. It will show us whether the momentum in AI infrastructure is grounded in real corporate spending or simply retail hype chasing the next big thing. Let's start with the Wall Street narrative. 5 different analyst firms raised price targets for Marvell this month. They are actively pushing their clients into this trade, heading into tonight's print. This chart maps the analyst tape. The mean price target sits at $174, while the stock trades at $208. That $34 gap means Marvell must deliver absolute perfection tonight just to justify its premium. Now compare that retail buying frenzy against what the people running Marvell are actually doing with their own money. This shows the net insider buying value across the entire networking basket. Marvell insiders executed 80 separate sell transactions, pulling $107 million out of the company. 12 days ago, the CFO and the Chief Operating Officer, two people who already knew what tonight's earnings numbers would look like, both aggressively cleared positions. When retail eagerly buys the exact same shares that corporate officers rush to unload, you step into a massive informational disadvantage. You have to navigate this carefully. Looking at the structural evidence heading into tonight, the setup is almost perfectly tied. This scorecard ranks 6 key dimensions, and it tallies up to 38 points for the bull case and 37 points for the bear case. The bull argument relies on high-demand data center products. Buying the stock now gets you direct exposure to Marvell's custom silicon and optical routing segments before they issue their next quarterly guidance. But taking that trade means you accept the cost. You are paying a heavy premium and choosing to actively ignore the stark red flags in both the valuation gap and the massive insider selling. The bear argument is about capital protection. Sideline your money tonight shields you against a highly probable sell the news reaction, where the stock fades back down to that $174 mean target. The trade-off there is opportunity cost. If Marvell delivers a blowout revenue, beat the stock will likely re-rate above $220, and you will miss the clearest confirmation trade in the sector this quarter because neither side has a structural edge here. The market is locked in a tug of war. Raw momentum is pulling the stock up, while fundamental valuation gravity is dragging it down. To see how large institutional money is handling this tied setup, we can look at the options tape. What stands out immediately is that institutional commitment is unusually weak. The total options premium laid out for this earnings event is only $8.78 million, while the trades do lean bullish, meaning there are more call options than puts. That low dollar amount tells us institutions are not willing to place heavy crowded bets on tonight's outcome. When institutional positioning is this light going into a major binary event, it guarantees exceptionally sharp volatility tomorrow morning. Regardless of which direction the stock decides to move, the smart money is sitting on the sidelines because they know that trying to guess tonight's print in advance is a pure gamble. It is not an investment strategy. So shift your approach. Stop trying to guess the earnings print. Instead, prepare to react to the market's reaction using a specific set of rules. Tomorrow morning, this timeline lays out a Thursday morning grade. The first two hurdles are purely financial. First, Marvell's Q1 data center revenue needs to exceed $1.85 billion. Second, their Q2 guidance midpoint must be $2.55 billion. The final two hurdles happen after the numbers drop. Management must provide positive commentary on their custom silicon and optical data ramp during the earnings call. And crucially, the stock must hold the $200 level at tomorrow's open. Here is the upside path if at least 3 out of those 4 triggers fire. The market has validated the AI networking thesis. The re-rate is confirmed, and the stock is positioned to push through $220. But if only 0 or 1 of those triggers fire, the hype was invalid. The stock will quickly lose its premium and begin a fade back down toward that $174 meme target. Utilizing an objective framework like this entirely removes the emotional panic of post-earnings volatility. It clearly dictates your safe entry and exit levels without the guesswork. If you are an active optimizer, your play is patience. Do not front-run the news tonight. Wait for the pre-market tape on Thursday and only execute a trade if 3 of the 4 triggers are mathematically confirmed. If you are a value-conscious investor, that $34 gap is simply too wide to risk your capital right now. Wait for Marvell to miss a trigger and force the stock back to the 174 mean. That secures a much wider margin of safety for your long-term AI exposure. And if you are a beginner, completely avoid this single-name catalyst. The informational disadvantage of buying right as corporate insiders are aggressively selling is far too high of a risk. For your portfolio, surviving the AI infrastructure hype cycle requires discipline. It means refusing to buy blindly into market momentum, demanding actual mathematical proof, and aligning objective data triggers with your personal risk tolerance before the opening bell even rings.